Hello and a very warm welcome to a brand new video. Today we're going to take a look at copper mining stocks with particular consideration of the ongoing Iran conflict, because the longer this conflict persists, the greater its repercussions will be on the global economy. And who is there better to observe than Dr. Copper, the price of copper? We're going to analyze exactly that now, and of course the copper mining stocks too.
We'll try to put this into perspective.
What in the past can we best compare this this situation, this crisis to, so that we are best prepared for the next weeks and months? But before we start, of course, the risk warning that everything I say does not constitute a buy or sell recommendation and is not financial advice, but merely my own opinion.
So let's go ahead and dive right into the copper price.
And here we see the copper price on the daily chart, which means each candle represents a single day. And here we can also clearly see that copper has lost some ground in price. It's not as significant as the stock markets. We're currently looking at an approximate price drop of about 6% from the current level. This is still moderate, but we're seeing the downward trend in copper. Similar to the Nasdaq, copper had actually held up quite well in recent weeks, and only now in the past week has the copper price also somewhat come under pressure. And this is precisely the scenario that the stock market is increasingly pricing, in that it's not a short-term conflict of just a few weeks.
If that were the case, then the consequences for the global economy wouldn't be quite as significant.
If we were to consider what the implications would be if this conflict were to persist here for an extended period, then we only need to consider what the World Trade Organization has already indicated. And that is also somewhat reflected in the information presented in this report, that a global recession risk could potentially be on the horizon. And that's why it's important to keep that in mind, especially at this moment, if the spiral of escalation continues to spin and we don't see any signs of the tension easing. This means that if we don't resolve this conflict in the coming weeks, then the issues and supply shortages concerning energy, specifically oil and gas, will truly and ultimately spill over into the global economy, leading to widespread factory closures. We are already witnessing this across various sectors, particularly in Asia, where they have already started to ration energy. This means we have a genuine scarcity of this raw material, and that will then ultimately, of course, influence the demand for copper. And we're seeing that now in the latest movement. This means the longer this conflict continues here, the further copper's price will also fall. The copper mining stocks, which we'll look at shortly, are of course also affected by this, partly, but also by the high energy costs. I'll get to that in a moment. Now, let's take a little look back into the past to see what we can best, compare this situation with. If we consider the attack by Russia on Ukraine, for example, that only caused a short-term, a price drop in copper. But now we're confronted with a completely different problem here, namely that we could face a global recession, and that's actually more comparable to Corona, I would say, because it could also very strongly affect the supply chains. And if we look at the Corona situation, we can also see that copper for a time lost 30%. And that is with these 5% we currently have. If I just take the average, or even almost 7%, there's still a considerable amount of room to fall. This means it's quite possible that we could see copper prices drop below $5 per pound here. This is precisely what I would anticipate if this conflict were to just continuously persist, that we would eventually come to touch this trend line and quite possibly even fall below it. So for the copper mining stocks, this means continued pressure. And of course, now here, let's take a look at the individual copper mining stocks. I've already mentioned, of course, that the copper price is one factor that leads copper mining stocks, I'd say, to price losses on that front. And we also see here that copper mining stocks had already started much earlier to lose this upward trend. This means we've already seen significant price losses here since March 4th, basically, since the conflict here has continued to escalate. And we're now seeing falling copper prices being priced in, but also rising energy costs. And these rising energy costs cause copper production costs to climb, and they shouldn't be underestimated because energy costs account for about 30% of production costs on average. And that, of course, clearly impacts the margins here. This means on the gross margin and then, of course, also on the net profit margin. And that will naturally affect Freeport-McMoRan, where we've already seen a deterioration of the margin, which is significant from 33% or let's say 30% on average to now just 12%. And I don't believe in the current market environment that it will significantly recover. So we should continue to see further pressure on the stock. That means Freeport-McMoRan is generally not very interesting for me right now because its financial or rather fundamental key figures don't quite appeal to me as much as other stocks. From a valuation standpoint, we must also acknowledge that we're coming from a rather positive level. Yes, we had a growing global economy. We have increasing demand from robotics, data centers, etc., which naturally also drove valuations upwards. And we see it here with the price to sales ratio. Freeport-McMoRan at 3.2 is still elevated and above the average. Yes. There's still price potential here. If we look at the average of the last few years, 20 to 30%, let's say 25% is certainly achievable here, which I definitely expect for Freeport-McMoRan. This means the stock is definitely not interesting at its current level. I would be very, very cautious. And that's precisely the case with many other stocks as well. The same applies, of course, or it also applies to the PE ratio, yes. The price to earnings ratio is also elevated precisely because of this positive outlook. And if we now convert this positive outlook into a negative one, meaning a recession, dwindling demand, then it will mean that we cannot maintain these valuation levels and that we will rather fall into poor valuation levels like below 20. This means with the price to earnings ratio, which the stock market tends to focus on more, there's still quite a lot of pressure regarding that. We even have greater upside potential there. I wouldn't go so far as to say it has to come to that, but I do believe that we will certainly see Freeport-McMoRan drop towards $40 here. Let's move on to the next stock, and that is Saffron Copper. And if we take a look at the fundamental key figures, you'll already see why I like this stock significantly more. We also have a chart here naturally, which has performed significantly better than Freeport-McMoRan. And this is fundamentally underpinned, which is why I generally prefer this stock over Freeport-McMoRan, even though Freeport is, of course, a bit more popular among investors and also better known, so to speak. We see exactly the same picture here. Right, Saffron Copper has also lost quite a bit here in the last few days, even a bit more than Freeport. We're already seeing the stock 23% lower than its initial starting level. Naturally, there are certainly reasons for this development, and one of the primary reasons is the very high valuation that we currently observe here at Saffron Copper. We're looking at a price to sales ratio of more than, well, actually more than 10. That was already truly at a historically elevated level. You can see it here on the chart. The stock goes back to, or the chart goes back to 2006, and we're now here, or rather, we came from a level, a price to sales ratio of over 13. This is actually already valuation levels, or a valuation level of a tech company, which we now see here in a commodity stock, and therefore, I would say that was an overvaluation, and this overvaluation is now being unwound. And I also believe, as I mentioned, if this scenario plays out where we face a global recession, and for that the conflict would need to continue for several more months, or no end is in sight in the coming weeks, then I think we could lose another 30% on Saffron Copper's stock here. I've already prepared something here, a price target that I've set for myself, and that roughly hits the 30% that I expect at minimum for Saffron Copper. This is, of course, generally speaking here, a scenario, a possible one, or a first objective that I have. Should the conflict, of course, continue to escalate, then it could very well be that we might see further overreactions or additional price drops below $100. That cannot be completely ruled out. This means one generally needs to be very careful when investing in these stocks now, but we will naturally cover that in the upcoming videos. So a quick note, feel free to subscribe so you don't miss anything, and a thumbs up if you liked it or still like the video. That would make me very happy and support the channel. So, as I mentioned, my first goal is to reach about $110 to $120 in Saffron Copper. Saffron Copper is also a pretty good stock regarding its dividend yield.
Currently 12% would be nice. Well, 2% is already quite good. The dividend yield naturally goes up, but it's also, of course, threatened by the reduction or the pressure on margins. And we can see here that the gross margin is significantly better or more stable and has also improved in recent years. This also shows how well the company is doing, but I think we'll see a dip here too. We won't see these high margins above 50% anymore, but below that due to the increased energy costs. And depending on how much further oil prices rise, margins here are likely to come under even more pressure. So from a valuation perspective, as I said, we have downside potential because the stock is still valued relatively high. In terms of the price to earnings ratio, we've already come down a bit from the high levels of 40. That's already quite good. But even here, if we take a look at the chart, the data goes all the way back to 2006. If we then consider the average of phases where things weren't quite so euphoric, then there's still a price risk of at least 30%. So the stock truly still has significant room to fall. You shouldn't underestimate this, and generally in such critical global crisis, you shouldn't make the mistake of jumping in too early. That applies to copper stocks, but also to all other stocks that are currently getting a bit crushed and are in a downtrend or a bear market. So let's move on to the next stock, Antofagasta. Let's speed things up a bit because the exact same image fundamentally appears here too. A well-performing stock. In recent days, it essentially fell below the moving averages. This means we're essentially in a downtrend by definition, and it will naturally accelerate further if we fall below the 200-day line here. That's at about 280 British pounds or 2,800 British pounds. I think it's pence. That means if we fall below that level, then more sell signals could be triggered. This means significant selling pressure could come onto the stock. These are the levels I'm essentially watching for the stock right now. And from the current level, we've already fallen quite a bit. Yes, we're already 27% in the red. Then from the current level, that would again be another 13% or even another 30%, which is quite possible. As I said, analogous to other stocks, essentially. As for the valuation, it's exactly the same situation. Very high valuation, a lot of euphoria surrounding this stock, and that is now being dismantled, and consequently we once again face a significant risk of loss in this regard. And it's precisely the same with the price to earnings ratio, currently standing at 32. I believe that we will see it drop significantly below 30, moving more towards the 25 mark. And this price to earnings ratio will naturally climb as earnings start to shrink. This means the stock is also facing additional pressure from that side because, of course, the rising energy costs result in reduced earnings, which then leads to higher PE ratios, even with unchanged revenue. This means the stock also experiences further selling pressure from that front. That means currently, as I said, here too, the price target is rather the lower end based on the current news as of today, Saturday, when I'm recording this video. First, quantum metals. Yeah, I was pretty bullish back then, but things have changed here as well. Clearly, the chart is identical. Valuation-wise, we're coming from similarly euphoric levels, looking at history, and I think we'll fall back to those levels here too. So here too, something like 30% is definitely possible for this stock. The same applies to the price to earnings ratio. And here we already see the weakness of First Quantum Minerals. We see here regarding the net profit margin, it's already at a very, very precarious level on very, very thin ice, and that is now completely collapsing, of course. And I believe we will certainly see the net profit margin in negative territory for the upcoming quarters. That's obviously not good for a stock price. This also means significant downside potential for the stock. I think that here too, significantly lower levels are what we can expect. I believe the first levels, or rather the targets I personally mark out for myself, are typically around, 20 Canadian dollars, but then also quite a bit lower, in the vicinity of 15. These are the objectives that I currently have in mind, leaning more towards the lower end of that spectrum, because right now I simply don't see any signs of relaxation, and this scenario of a global recession, its probability is constantly increasing. Let's look at China. And that's also a very, very interesting situation, because China is naturally suffering from this too. Clearly, we're not talking about a regional conflict here, one that has regional impacts on the economy, but a global one on supply chains. And this will, of course, also be reflected in Zijin Mining Group's performance. And here too, we will see price losses. This means, I believe, that we will soon break through the 200-day line, which is currently around 28 Chinese yuan. And yes, and here the stock fundamentally has also performed very, very well. This means if we break through the 200-day line here, purely from a technical chart perspective, this last consolidation phase was also here. The support zone is right here. Then soft selling signals are triggered once more, and there's not a great deal of support. The stock has built up technically and high CA. This means the risk that we could definitely see a sell-off down to around 20 Chinese yuan is certainly there. This also means a price risk of 20% is quite realistic. And if we look at the valuation, the price to sales ratio is similar. Yes, here too, if we return to these levels, these initial levels, something around 30, even over 30% is definitely possible. This means that here too, we see exactly the same picture as with the other stocks. The price to earnings ratio is actually still a bit better. As for profitability, the company has managed its finances really well, it must be said. It has already come down quite a bit. However, due to the high energy costs and also considering that China does not have unlimited oil reserves, the PE ratio will naturally tend to increase. This means that here too, valuations will be adjusted downwards, and that naturally results in falling stock prices. Because if, for example, the available energy reserves here were to run out, then it's quite possible that we might also see factory closures, which would naturally then have direct significant consequences for the respective companies. So the net profit margin here in this particular aspect is a bit better, and it has also developed really, really well. That's also a significant reason why the stock has performed so well. Clearly, if you have such a good fundamental basis here, it will be priced in positively. The net profit margin will naturally also decrease due to the increased energy prices. That means I think here too we will fall below 10%, and I'm curious how much further the oil price will rise. If we then see an oil price reaching $200, then I believe it will also become very difficult for these companies to still remain profitable. All right, that's all from my side for now. I truly hope you all enjoyed this video. Please feel free to write in the comments how you currently view the copper market or the global economy in general, because it's often beautifully said, Dr. Copper is a clear mirror for how the world economy is truly doing. And I think that captures it quite well, so I always keep a very close eye on it. Please share in the comments how you see this matter. Then we can discuss that a little, and I hope we'll see each other in one of the next videos. Until then, I wish you all the best, much success, and goodbye.